and as soon as possible. Oh, this guy's share everything. So let's take a look, guys, to the Excel file. Yeah, do you see this one here?
Yeah, for 2,
Yep.
I put accounts receivable at 20 because it says credit 30 days no interest.
Yep.
But in the solution, it wasn't there.
Oh, interesting.
So I'm not sure if I'm wrong or not.
Yeah, no, but perhaps. Let's take a look, okay? So I have, okay, wait. Do you have other questions? So this is one question that we're going to review in detail. Do you have another questions, guys? So we can go through this process and then we can discuss a little about the midterm, and then we continue with the class. Any questions? Any additional questions? Do you understand everything?
I'm okay. Just reviewed it. So.
Yep. So everyone, you were able to do that, guys. Remember, you need to practice. The only way you can practice is by doing this type of exercises. You have also the first one, guys, is for review, so you can redo that again. So you should be able to do these type of things. Okay. So what we say here in number 1, let's do this very quickly. Okay, let's go through all the process. So what we say in number 1 is I buy inventory 72 cash and 68 30 days, but they are going to charge us a 5% interest. Right, so the total amount is 140. Let's take a look. So I have cash 72 negative, 140 is my inventory. So how do I buy my inventory? Cash and accounts payable. Do you agree?
Yeah.
However, we have a 5% interest rate. That is not in the numbers are not in here, but they tell you they're going to charge you 5%. And remember, guys, that this is a very short-term loan or credit. So this implies that this 5% needs to be considered in your solution. So that's why I include, this is a 3.5 is 5% of 68. And then how do you cancel out this transaction? This immediately goes as an expense, 3.4. Make sense?
Yeah.
Guys, make sense to everyone?
Yeah, I got it.
Yes, so we
Okay.
assume that we pay right away the interest, right?
Yes, we need to basically, it is not that you pay, because remember, if you pay right away, it should go in cash. Because you're not paying right away, that's why you're considering this as a short-term liability. But what is considered immediately, and I think that's where you wanted to go, is that I immediately, even though I haven't paid, I need to consider this one as an expense.
Yeah, I guess the only thing is that because we have both expense and cash in the same form, it just confused me a little bit, but it makes sense, yeah.
But remember that what is interesting about and what is the main difference between the P&L, because remember this part, what I'm doing. Because the P&L, between the P&L, remember this is the P&L, do you remember when we have done the analysis, this is the P&L. The main difference between the P&L and the cash flow is that sometimes the expenses are not necessarily liquid. So I haven't paid this one. I know that I need to consider this one. I haven't paid because I have this as a liability, but I have considered this immediately as an expense. This is one of the principles of accounting, prudence. Okay? Make sense, the first one?
Yes.
Perfect. So let's go to the second one. The second one says that I sell merchandise, cash 180. I give a credit for 20. The sales taxes, you know what, perhaps I can put here, paid in cash.
Yeah, I got confused there.
Yeah, paid in cash, should be paid in cash. You prefer always to be paid in cash, correct, guys? Remember the taxes? The taxes are always better to be paid in cash. Otherwise, you're going to be paying this to a government even though you haven't asked for that money already. So let's take a look. So let's say, okay, I'm selling. So I'm receiving 195, correct? These two amounts of money. That's what I'm receiving today. So I'm receiving 195, okay? From this 195, only 180 are mine. 15 is going to be sales payable. Oh, guys, can you give me please 1 second?
Sure.
Okay, just give me 1 second, please. Sorry for that, guys. There's an issue of being at home. Okay, so what was I? Okay, from these 195 guys, 180 are hours and 15 are not hours. That's for the government. Do you agree? So that's why I need to separate from this 195. 15 goes to the government. I haven't paid yet, so that's why it is a liability, short-term liability. However, I have this 180. Yeah, and I have this 180 as my revenue. Make sense to you?
Sorry, it's not 200.
No, because you know that's prudence. In my I have I should have somewhere. Oh yeah, you're right. There is something missing here. I know what is something missing. So here we have also credit on 20. Completely right. And so now my income or my revenue is going to be, I will write this just to be sure, equals this one plus 20. That's completely right. Because I need to register that immediately. Make sense? So indeed, what is mine is this 200 minus this 18. Sorry, no. 125. No, the sale is 215. That's correct. So 200 is mine and 15 is from the government. Someday I will pay this 15. I don't know if I pay this in the future, but I should pay it. Make sense to you guys?
Yeah.
Okay, perfect. Oh, well, and this has a cost of goods that is 100. And of course, the 100 goes immediately with 100 here and as an expense for this transaction. Questions, guys, about question number 2?
Clarify. So when you purchase the inventory, there, with cash, for example, you purchase inventory with cash.
Yes.
You do not, you do not register it as an expense because you're transferring it from one asset to another. However, when you do sell the inventory,
yes, you need to
register it.
consider all. Yes.
You consider it now as an expense afterwards.
Yes. Okay. So remember this one here, guys. It can be done in a single line. Okay. I just done this in 2 lines just to show you, but indeed you can put a minus 100 here and a minus 100 here. So you can do this in a single line if you want to. Just for, yeah, just to keep track of what I'm doing, I'm simply doing the revenues and the costs. Make sense? In the exam, guys, I will give you something like that. If you have 2 lines, please use 2 lines. If I give you 1 line, you can use the simple line. Okay, so here we go. Recognize salaries to be paid at the end of the month. Oh, this is something that always happens in accounting, guys. Also is related to prudence. You haven't paid salaries, but you need to consider how much salaries you're going to pay at the end of the month. Got it? So I recognize that at the end of the month, I will pay in salaries 36. And immediately I need to recognize this as an expense. Got it? Remember, this is simply a recognition. This is an accounting recognition. I know that today is the 1st of November, and I will pay on November the 30th, $36. So I know this, and normally what I do is I need to do this registration. I need to recognize I will pay 36, and this goes immediately as an expense. Now, when you talk about salaries, guys, the recognition is 30 days. Okay, so you're not going to recognize the salaries for a full year, for example, even though this is considered in accounting short term. For salaries, the rule, the GAAP rule, is simply considered to recognize month at the beginning of the month what you're going to pay at the end of the month. Right? So this is a new transaction that we didn't have in the previous one. So that's why I created this one. Make sense, guys? So you haven't paid salaries. Please pay attention here. So you have only recognized that you are going to pay salaries at the end of 1 month. Make sense to everyone?
Yes.
Perfect. Yeah. So let's go to another one. Okay, then I will pay 15. I don't know why I've decided to pay 15. Why 15? Do I pay salary somewhere else?
No.
Yeah, you know what I can do is 1/8. So let's make this more coherent. So 8 is 31 days, right? 1/8. This is January. January 38. Yeah, we need to make this more coherent, guys. If we can just please put 36, because I need to consider, I need to pay what I have said I need to pay. So basically here should be, this one should be 36, and this one should be minus 36. So when I actually pay, I need to pay from cash. Got it? And this simply decreases my wage and salaries payable. Makes sense to you guys? There is nothing more. There is nothing to report here in expenses because it has already been reported as an expense. Got it?
Yeah.
So now let's go depreciation. Well, depreciation, guys. I'm saying that is 17. So this is accumulated depreciation 17, and this always goes as an expense, correct? 17. So expenses are always like that, so it's easy to manage. Depreciation. Then I go interest paid in cash for transaction number 1. So what I'm doing is I'm paying. Remember, I have a debt here, but this debt was already considered as an expense. However, it was not paid cash. So what I'm saying here is, okay, I need now to pay the cash, so I need to eliminate this one here. Correct? So that's the way you clean your interest payables. Now the next one is I pay my interest, the tax sales tax payable. So remember, I collected 15. Now this is the end of the month. I need to pay this 15. So remember that these 15 guys are not ours. So that's why we don't have any revenue or expenses here. What I do is simply close this position, 15 here, and then I use cash to close this position. That's it. Okay. So number 8, I simply buy fixed assets for cash. For cash, okay. So what I'm doing is I'm subtracting 287. I'm paying cash 287, and my fixed assets are growing to 287. Make sense to everyone? What I'm doing in number 9 is I'm selling equipment by 10. Okay, I received 10, so this is an extraordinary revenue. Agree with me? So this is not part of my business. That's why it's called extraordinary revenue. In any case, it's also called here revenue. So 10. And the cost of this 10 corresponds to reducing my fixed assets in 10. So at the end of the day, my expense is also in 10. So at the end of the day, guys, I have sold something at 10 that is worth 10. So basically, I'm making no money from here, not extraordinary income from here. Correct? Remember in the previous class, what we did is we sold for less than the book value. So then we lost money. So this is also possible if this number is smaller than this one here. But also this number can be larger than this number here, so you can make extraordinary income. That also can happen. Questions? Guys, questions? Are we agreeing up to there?
Yeah.
Yes.
Perfect. Now we do is issue a long-term debt for liquidity needs. So basically, I need capital, working capital. Yeah, I need money. I need cash. So what I do is I receive cash, and this is going to be a long-term debt instrument. So I call long-term debt. That can be not necessarily a bond, can be a IOU, a long-term IOU, or can be any document that simply says that I will pay you in the future. Right? But here I have something interesting. Yeah, okay, so this is the one. So I have 6 years, 3% per year. So basically I need to pay $18, correct? $18,000 or whatever. Agree with me, guys? In total, I will pay per year, I will pay $3. How many years? 6 years. So in total, I will pay interest $18. Now, careful, guys, that when we have a long-term instrument, we need to separate the interest payable. So the one that corresponds to the year, to the current year, is going to be a short-term liability. And the remaining quotes, the remaining interest I need to pay after 1 year are going to be long-term interest payments payable. But these guys are not going to be in the balance, are not going to be in the financial statements. They're going to be like notes. Remember that? We mentioned that in previous class. So basically, guys, I have my, I recognize my 3 coupons payable, and I immediately recognize this as an expense. And the 15 has nothing to do here. You see, there is no 15 in anywhere here. So what I do is I simply write a note, something like that. Note 1, 15, long-term coupons payable for next 5 years, something like that. Right? And then the note simply explains the user, oh yeah, this is only short term, and they have more debt in the future. Do you have this clear?
Yes. So just the face value of the bond that we include in the balance sheet, but the actual long-term coupon payments we don't.
This 100 is the face value, yes.
Yeah, so the face value we include the long-term one, but the long-term coupon payments we do not include.
Yes. So remember that the long-term debt is debt. So this debt doesn't influence your P&L. Remember that this part here, why not 15 or 18 here directly, is because if you put 18 here, the taxes are going to decrease. Do you agree? The ACC, sorry, not the ACC, the IRS is going to receive less money, so they don't like that. So that's why they tell you, wait a second, you know, this one here is only the one that corresponds to this year. All the remaining ones are outside the balance sheet. You need to recognize them, of course, outside, but they are not here because they cannot affect your expenses.
I understand.
Makes sense. Perfect. Okay, so now let's go to 11. So we issue common stock for cash. So I issue 98 in dollars. I increase my common stock, my paid in capital or common stock by 98, and that's it. This is not an expense. This is not a revenue. So it's simply a balance sheet transaction, balance and cash flow transaction. Make sense? Give me 1 second. Okay, guys, I'm sorry. So I pay dividends, okay? So dividends are cash transactions, so they decrease my cash. And these are as an expense. Okay, so here's a discussion, guys. So what happens with dividends? Okay, I put this on purpose. So what is the treatment of dividends?
An expense.
It is an expense, but you need to be very careful, guys, because when we create our P&L, so let's do a double start here. Because remember, the dividends are paid after you pay after you pay taxes, correct?
Correct.
Okay, so we need to be very careful with these 19 paid dividends, guys, because you can consider this in here, or sometimes the people, what they do is they consider this one here as outside this one here. So basically, you simply consider a 19 as sorry, as note 2, you say note 2, 19 paid in dividends or dividend payments. Okay, so why is better to consider this as a dividend outside the rule, guys, outside of the book? Because what happens is that indeed, if you put the 19 here, or the minus 19 here, your P&L is going to change. It's going to appear as a less profitable. You agree? So that's why please note that dividends, even though you can register them here, I always prefer to consider them as a note. You know, technically also by GAAP, guys, dividends are not considered in any of the statements. Okay? They have notes. They have special books for dividend payments that are called the corporate books. In the corporate books is where you register all the dividends paid to all your owners. Got it? Do you understand that? So please remove this one here, this 19 from here, and then just make a note. And why I don't consider 19 here, because it can, you know, mislead you in terms of, if I put minus 19 here, take a look to what happens with my profit. It's 22. It's not true. Okay? So we simply delete this one here.
Sorry, but what's the corresponding?
Nothing. You
But
delete all.
But you're still
Just give me
distributing the dividend, so you need cash for that, correct?
Yeah. Yes, but the cash, that's what I'm saying. This one here, where's my solution? This one here. Okay, I will explain you when we finish the P&L. Let me do two.
So in other words, for this line or for the 12th transaction, we don't put anything.
No.
Okay.
In the book. Oh. Yeah, I will explain you you're going to get it just in a couple of minutes. Okay. So we can do the balance or the P&L that is easier. So what are my net sales? Do I have net sales in my solutions? This one, right? This is the only one that is a sale of inventory, correct, guys? My cost of goods are going to be, my cost of goods are this one here. Guys, do you agree?
Yeah.
Perfect. So just to be sure what we're doing, let's block. So these two are already considered. Oh, yeah, perhaps we can do okay. So we have considered these two already. Now let's continue with my P&L accounts. So sales and marketing, research and development, general. I don't have sales and marketing. I don't have research but I have salaries, right? So this is what is called general administration. So I can go here, this one here. What is this 17 here? Oh, depreciation. Guys, are you with me up to now?
Yes.
Okay, perfect.
Yes.
Depreciation is simply you go here, and where's my 17? Is this number here? Okay, so let's put this okay. What is this 10? Oh, this one here, guys, is extraordinary. So these two are extraordinary income, correct? Guys,
Correct.
you agree? And also this 3 is what is 3? Oh, this is financial expenses. Okay, so basically here, guys, net interest income expenses. Okay, I have a couple of them. I have my 3.4, and I have my, I think it's this 3, correct? Correct, guys?
Correct.
Oh, what happened? And I have extraordinary income or expenses. Well, in this case, it's going to be 0, but let's put these two together. It's going to be this plus this, correct? Yeah, so one way of seeing if we are correct is checking this number here with this number here. Do you agree, guys? So our P&L is correct because the difference between these two numbers, 40.6, is exactly the same as the difference between income before taxes in here. Guys, questions? Now it should be clear, guys, why the 19, the how do you call it, the dividends cannot be here. There is no account for dividends here. Got it? So now let's continue. Let's consider the income tax. I have a positive here. So my income taxes, let's put now 25%. 31%. This is current in USA. So basically it's going to be this one times 21. So if you can change to 21, it was 30 before. This was 3 or 4 years ago. So what is your net income, guys? What is your net income? $32, you agree?
Sorry, I'm adjusting the calculation.
Yeah. No, adjust.
Yeah, I got the same. I got the same as well. 32.
Yep. Perfect. Yep. Perfect. Guys, everyone has the same number?
Yes.
Perfect. So now is where you can sell, you can pay dividends. Do you agree? So if you can dividend payment, you can pay because you have 32. Careful, guys, and this comes with the relationship with what Daniel was saying. Hey, wait a second. Remember, not all this is cash. I need to be sure that I have cash to pay the 19 dividend, the $19 dividend. Do you understand what I'm saying? I want to pay a dividend of 19. I have a net income of 32. So indeed, technically, I can pay this one here. However, be careful, guys, because dividends are payments in cash. So what you need to take a look first is, do I have cash? Guys, do I have cash?
You have
No.
No,
No.
I don't have cash. You know, I don't have cash. So that's why I was asking my liquidity. So guys, can we change number 10? Let's change number 10, 250. Otherwise, I will not have enough money. Okay, so what I'm doing is I'm changing 10 to 150 just to have some flexibility. So 4.5 is going to be short term. So what I will do is, this is 150. Long-term debt is 150. This one is 4.5. And my note is, it's not 15 anymore. It is 22.5. I have done this, guys, just to be sure that I have enough cash. Yeah, we don't need this part here. Oh, wait a second, what was this? Guys, you get it?
Yeah.
Guys, do you get this one here?
Yes.
Okay, so here we go to the dividend payment. So I said, yes, I have been profitable. I can pay a dividend of 19. Yes, because I have cash. Correct? So basically, at the end of the day, retained earnings are going to be equal to what? This number here minus this number here. Correct? Because remember, guys, what you do with this money is two things. One, you can pay dividends, and the other one is you retain earnings. Make sense to you? Do you understand?
Yes.
Okay. So now we need to adjust. You know, there is an adjustment. This is an adjustment you need to do to your balance. So what you do is outside, you're going to do adjustment for dividend payments. And when you do, this account only affects this one here. And this one here is going to be equal to the P&L, to this one here. So let's call end of year cash now is going to be basically this one here minus this one here. And I need to do something more. I will explain you what. But at this point, it's clear.
Yeah.
Guys, are you following me up to this point?
Yes.
Yes, Prof.
Okay, so we are going to make some adjustments later, but let's continue here. Okay, so my P&L is done. Everyone is happy. Now let's go to the balance. The balance is, okay, what cash do I enter here? Well, the adjusted cash. So let's take a look. I need to enter this one here. That's because that's what I will have in cash in my bank. Okay. Then I have my, what do I have here? So let me put this one here. Accounts receivable. Accounts receivable is 20. Inventory is, that's easy to remember. You just need to match the names. I don't have prepaid expenses, so my total assets is 80.6, I assume. Yeah, this is long term already. So what I'm doing. So this is long term. So then I go my other assets, fixed assets at cost my fixed assets are going to be my 277. My accumulated, I don't have FF&E. I have my accumulated depreciation. That is this number. So I have 294 and I have 374.6 as my total assets. Then I go to accounts payable. Do I have accounts payable? Yes, I have accounts payable. My accounts payable are 68. Then I don't have anything else, right? I don't have accrued. I don't have anything of this. I have already cleaned all this part here. Do I have a long-term debt? Yes, I have a long-term debt that equals, what is my long-term debt?
Sorry, don't we have the coupon payable? The short
Sorry, go back. What?
The current portion of the debt, the coupon payable.
Aha, where is that? Yes, we have that. You're completely right. So my current portion of the debt is this one here, right? It's 4.5. Yeah, I can move this to be 4.5. You agree? Yeah, you're completely right. And then I have capital stock. My capital stock. Where's my, is this one here? Are we considering everything? Wait a second. So let me see. Oh, here we have a -2. Sorry, this is this is 4.5. Let me see what I've done wrong here, guys. 1 second. The transaction that I modified is okay. 150 here.
Is the expense negative?
Oh yeah, you're completely right. -4.5. So now it's clean. So let me see the P&L. Sorry, not P&L. The 4.5 is here. 98. Okay, so let me see what is this one here. Capital stock. Okay, so there is something that is. I think there is something wrong here. Let me see this one.
The retained earnings.
Oh yeah, here guys is a plus because I'm using negative numbers. So normally guys, what happens is that the accumulated, if you can do in the accumulated, if you can please do the negative, because in the balance sheet, normally the accumulated depreciation is presented as a positive number. Okay, please change, this is a minus solution L20. So this is my accumulated depreciation. Normally it's presented as a how do you call it? A positive number. Make sense? Okay, so what is missing here is my retained earnings, correct? Where this number comes from?
The income statement.
The P&L. So retained earnings is this number here. And where are we missing? What are we missing? So, so what is the difference here? It is this one minus this one, 821. So we have done something. So let me see if in the P&L. Let's see. The way of checking this one here is the following. Let's take a look to. I will copy this one here. Okay. I will copy these numbers in here. So up to here. And I will, so what we are doing now, guys, is trying to understand where is the difference. That's what we're trying to do. So now what I will do is if I sum this number here, I have 341. Yeah, 341. So this part here apparently is correct. So now we need to go into the other side of the equation. So I will copy. Oh yeah, I know what's going on here. Retained earnings. I just want the revenues. So my revenues, and this one is 39.1. So let me see my P&L, 31.9. Oh, yes, of course. My sales taxes. Yeah, I know. This is my sales taxes that I need to consider. There is an additional adjustment here, guys. I need to do, can you please do a second, can you add two additional rows here? We need to add the income taxes, guys, because this is also needed. I need to pay this in from cash. So the income tax is this number here. Yeah. Okay, so now everything's good. So I will delete this one here. I don't need this one here. Okay. So this one here is my income tax. So my cash at the end, my adjusted cash is going to be this minus this minus this. So this is my adjusted cash. Guys, do you follow me?
Yes.
Okay. So now everything should balance correctly. Beautiful. So my cash is this number here and everything balances perfectly. Do you have the same results? Guys, you have the same results?
Yes.
Okay, everyone?
Yeah, yes.
Okay, perfect. ETL?
Yes, Dr. Ngifo.
Perfect. So, Mariam?
Yes.
Okay, and Valentina, do you get the same? Valentina, do you get the same?
Yeah.
Okay, good. So questions, guys. So this was a more in-depth analysis because I needed to show you this part here. And also how this is considered here. So basically the balance sheet at the end of the year considers where are the dividends and where are the income taxes considered? Well, basically they're summarized in the cash. Right? So if you can see here in the solutions, that's what happens. You need to subtract the income taxes, you need to subtract dividends. And so at the end of the day, your cash is this one here. And this one here already considers these two parts here. Makes sense? And that's why, guys, managing cash is crucial because you can see here, guys, you see I have 30, positive, beautiful. Then you have an issue. If you don't have enough cash, do you remember at the very beginning it was minus 10 here? I don't have money to pay to the government. And so the government is the government doesn't care. You owe me money, you pay me now. I don't care if you don't have cash. So that's why we need to be very careful with cash needs. So that's why I needed, in this example, it was easy for me to jump from 100 to 150. But in real life, guys, you need to plan this. And normally the planning starts by mid-November. So you start doing all this planning of cash planning by mid-November because remember, it takes time to get the money, right? Make sense to everyone?
Yes.
Yes.
Perfect. So let me save this one here. Let's talk a little about the midterm, and then we continue with the class. Okay? No questions?
Dr. Ngifo,
Yep.
please may you kindly send this one to us because I
Yep.
noticed for some of my ones I was typing in your answer. I didn't click like the formula.
Yeah. So let me do this right away. Otherwise, I will forget. Give me 1 second.
Thank you.
Yep, my pleasure is here. So accounting, the name is the same. Okay, this is the one. Yeah. So you have 2 exercises, guys, to practice in the exam. Okay, so let me know when you have this one so we can talk a little about the midterm.
Yes, I got it now.
Perfect. Okay, guys, questions. So we can talk about the midterm. Do you see my screen, guys?
Yes.
Okay. So let's talk a little about the midterm. Okay. So first of all, the date, I think is 11/20. So let me verify that. Yes. So it is in a couple of Wednesdays. Okay. Not next Wednesday because it's election day on Tuesday. So I prefer to just play safe on the 11th. The topics are all up to now. Okay. So what are the topics that we have covered? Compounding interest rate, time transformations, then we talk a little about net present value, net future value, internal rate of return, correct? Then we have done discounts. We have done bonds, and we have done financial accounting. So basically, these are the topics that we have covered, guys, correct? Am I forgetting something? I don't think so, right?
Yeah. Good.
Yeah, and so the date and time, the time is going to be, guys, the same, 5:30, and we're going to have more or less up to 7 o'clock. So it's going to be prepared for this type of time. So you're going to be up and ready. Computer, yeah, you know, in principle, no. Okay, so if it's no, it implies that, well, yeah, I don't know. I think no. I prefer to do everything. So you're not going to be basically, I will give you some numbers about the internal rate of return, I assume. Well, perhaps you can do Excel for internal rate of return, perhaps that. Oh, guys, I forgot. We have done this one here. So we did mortgages, right? Or not? Can someone verify?
No, I believe we didn't do mortgages.
We haven't. So we didn't do 6 periods. We have an IOU. I don't remember, guys. Please, can you verify IOUs that I give you principal, then you have 6 months to pay, monthly payments is equal to that. We didn't do payment schedules, for example. We haven't
No,
done
I
that.
believe we didn't do payment schedules.
No.
Yeah, I can't recall, and I'm also looking through notes and can't find it.
Okay, so perfect. So someone can verify, so I can delete this one here.
Yeah, like my notes are, it went from NPV, and then we discussed
Discounts we have done, right?
discounting.
Yeah, discounting.
Yield to maturity.
Yield to maturity, bonds. Yeah, that's bonds. Okay, so forget about these guys. Oh. What was here? Net present value, discounts.
Yes, discount we did, Dr. Ngifo.
Perfect.
Discount
Bonds.
IOU, yeah.
Oh, we did IOUs?
Yeah, let me check the date.
Can you check IOUs, guys? Because
So
if
on
we have
the 2nd of September.
guys, so we have done IOUs. And so we have done payment schedules, ETL. So payment schedule is something like.
Oh, when you say you have like 120
principal,
days and.
Capital. No. This is discounts. Yeah. Okay, so I understand. No, we haven't done that. So that's okay. So the discount only. We have done discounts, IOUs.
Yes.
Yeah. Okay, so this is IOUs. So forget. So let me delete this one here. Yep. So this is the material that's going to be covered during the midterm, guys. Okay. So now how this works? I will provide you. You know, this is challenging because now normally it is a paper and then you need to compute everything. But now perhaps it's much faster if I give you an Excel exam and then you solve the Excel and then you send me the Excel to me. Yep. You know what? Let's do that. Make sense to everyone? So we have done most of the exercises, guys, in Excel. So bonds, you can translate the bonds into Excel. It's very simple. It's much simpler actually for you because you simply change. It's like having the notebook, but instead of computing one by one. Now it's going to be more complex. I don't want to complicate your lives here. Everyone has an scan available for you. Do you have scans?
Take a picture of it.
Yeah, that's right. Yeah, that's right. Just to be sure that you have a nice picture so I can take a look I can read that. So that's okay. Yeah, everyone has pictures, right, guys? But then can you please put them in PDFs? Otherwise, it's a kind of pain for me in a single document.
All right.
So, Professor, just to clarify, so you mean that we solve the problems, like let's say on a paper, and just take pictures and send it as a file?
Yeah. I think it's gonna be much easier because the class is not Excel. So if you, I prefer you solve like a normal regular exam, guys. I will give you the exam so you can use your calculators, etc. And then once you finish, you simply do a scan and PDF and send this to me. Okay, at the end of the class. So what I will do is at 7, I will say, okay, guys, time is over. I will give you 5 minutes to do the scanning and or pictures, etc. And then every one of you send me your exam to me, and then I need to tell you, I need to check, I need to verify that I can read, and I tell you, okay, Casigo, we're ready, and so you can be leaving. Make sense to you? So it's going to be like a regular exam, guys. So forget about Excel, no Excel. So forget about this.
So what about financial accounting then? So that part, how to?
Yeah, you're right. In financial accounting, it's much simpler to do in Excel, right? Yeah. Okay. Yeah, you're right. So let me think. Let's think. So we do the interest rate. All this stuff is easy to do by hand. So you can do this by hand. Bonds also you can do by hand. Financial accounting. Yeah, guys, let's do financial accounting by Excel. It's much simpler. So you can also have and I will give you more or less like the example today. Remember the exercise that we have done today. So you can simply go and fill the numbers, and then you can see that your control column is okay. So you are okay. So you can move faster. Okay. And also the balance and all this stuff is going to be there. However, guys, please pay attention when we do Excel. You cannot open any other Excel except a blank page, okay? Except the document that I will send you during the exam. Make sense, guys? So you cannot have open any other Excel file. You cannot have anything that has a solution already there. Make sense?
Mhm.
Okay, guys, questions?
So we're allotting 1.5 hours for the exam.
Yeah, 1.5 hours to do. Of course, I can do one question for the first part, another question for the second part, bonds and financial accounting. They're not going to be very big, okay? They're going to be smaller versions of everything. So for example, for financial accounting, 10 transactions like we have done in the exercise today, something like that, very, very small, very compact. So just show me that you can do it. Got it, and you understand how the transactions work. You understand what is the concept of P&L versus cash flow versus balance sheet, etc. That's important, guys. Really, all this part here from this class has a extremely real life applications, and I'm pretty sure you're gonna see this in a short term. Questions?
So the ratio analysis part in financial accounting, that's not gonna come up. Is that what you're saying?
Financial accounting is going to be by Excel.
The ratio, all the ratios.
No, we're not going to deal with ratios. So yeah, I'm okay if you understand them. This is good, but I prefer to just focus on the Italian method. Remember the big table, and then from there the balance and the P&L. Yep.
Okay.
Okay. What we have done today, basically, guys. That's what I really care. Okay, guys. Questions? So we can continue. Nope. Everyone is okay, guys?
Dr. Ngifu, will we have class next week, Wednesday?
Oh, no. Yeah. We continue classes even now. What we do from now on, it is not for the midterm. It's going to be for the final exam.
Okay.
Okay?
Yes.
So next Wednesday, I will have, perhaps 10, 15 minutes questions. Guys, you have specific questions. Don't tell me, hey, professor, can you solve a complete example? You tell me, hey, in this example here, I don't understand this part here. I don't understand this transaction here. So we can go over that in the first 10, 15 minutes, and then continue the class, and then the exam is going to be on the 11th. Okay? So we have regular classes. Okay? Good. So now, guys, let's start with something that's really interesting. So this is more applied for those people that want to do investments, okay? So let's start talking about portfolio management. Okay, here, guys, in portfolio management, what you're going to do is I will send you some material, PDFs of Excel files or photocopies of Excel files that you need to replicate. Okay, so you need to. I don't give you the Excel file because I want you to do them. Okay, by doing, you're going to learn. I will do this by the end of this week for you. Okay, guys, so what is portfolio management? It's basically what we're going to try to do is we're going to try to make investments, okay? Educated type of investments. And what we are going to do, guys, we're going to use a model that is quite easy and efficient that is called the mean variance model. Okay, so what is that? So the mean is going to measure my expected returns. And the variance, guys, is going to be an approximation of my risk.
Sorry, is this mean?
Yes, the mean, and yes, the mean with the is not an N, it's an M. the mean variance model, okay? So the mean, guys, for me is going to represent my expected returns, and my variance is going to represent my risk. Got it? Now, in terms of naming conventions, guys, I will call this guy, the variance is going to be sigma square. And sigma is going to be, of course, the standard deviation that also is called volatility. And we are going to be working with this one here. Okay, from time to time, the formulas are going to appear sigma squared, that is the variance. But in general, we work with the standard deviation. Why do we prefer, guys, a standard deviation versus the variance?
It's smaller.
Yeah, it's small because it's square root of the variance. That's right. But in terms of units, guys, the variance is units squared. So if we're talking about dollars, the measurement of the variance is going to be dollars squared. It doesn't make sense. The volatility, if we're talking about dollars, the units of the volatility is also going to be dollars. If we talk about returns, the measure is also going to be returns. So that's why we prefer the standard deviation that measures the volatility as a measure of risk. Got it? Now, guys, what we try to do in this class, hopefully we do 1 and 2, okay? There is a methodology, guys, that is extremely useful. The first thing we are going to do is something that is called capital allocation. Hopefully we are going to start this today. So what is capital allocation, guys? It's simply the decision of where do I put my money? I will have a risk-free portfolio. RF is going to be my risk-free portfolio. And I will have a risky portfolio. That's it. You see, I have a risky portfolio and I have a risk-free instrument. That's all. I only have 2 options. I don't care what is inside the risky portfolio. This is my capital allocation decision. I only have 2 options. I have my risk-free portfolio. This is RF. And I have my risky portfolio. And I will decide how to put my money in between these 2 guys. This is what is called capital allocation. Then the next step is going to talk about asset allocation. So what is asset allocation? So we are going to start moving or analyzing this risky portfolio, but at gross. So here, for example, we're going to talk about, okay, I want to invest in equity and I want to invest in debt instruments. Or perhaps I want to invest in foreign exchange, or I want to invest in commodities, general names. Or perhaps I want to invest on derivatives. Okay, more granular, but it's still conglomerated. So equity can have Amazon, Tesla, Alcoa, whatever you can imagine. But we don't care. At this point in asset allocation, we don't care about that. So asset allocation is risk-free portfolio together with all this part here. This is what is called, guys, asset allocation. And finally, I'm not sure if we are going to have time to do this one here. It's something that is called security allocation. So what is security allocation? Well, we need to continue breaking up this part here. So we're going to have the mixture of risky portfolio with now in equity, for example, I can have, as I was mentioning to you, I can have Amazon, I can have Apple, I can have Tesla, I can have different names. You see? So this gets more complicated now because here we started with 2 in the first one. Then we start with 1, 2, 3, 4, 5, 6 perhaps. And then here we have tons of different ones. So in equity, in debt, perhaps I do sovereign. I do investment grade bonds. Perhaps I do some junk bonds. Perhaps I do some munis. etc. Got it? And this moves in this way here. Make sense? The logic is going to be exactly the same. The level of complexity, of course, moves as soon as I'm moving from 1 to 2 and from 2 to 3. The math for 3 is more complicated, of course, because we have an optimization of multiple optimization with different instruments. So we are going to use Excel. Excel is going to help us. Hopefully we arrive to 3. It depends on you guys. How do you follow? And how do you feel with this part here? Okay, makes sense to everyone? So this is what we're going to do from now to the end of the class. Questions, guys?
Sorry, so the difference between all the three is that what, like from going down from 1 to 3, it just becomes more specific.
It's complex. It becomes much more complex. Here, the optimization is between 2. Agree? Here, the optimization is between 1, 2, 3, 4, 5, 6, and can be more, of course, but in this case, between 6 instruments. And here, the optimization can be, 30, 15, whatever you can imagine. So the level of complexity, guys, the technique, the idea is exactly the same, but the level of complexity in terms of optimization is harder and harder as soon as you move from 1 to 2, 2 to 3. Okay, make sense? Okay, so if you don't have questions, let's start talking about the capital allocation. It's very cool, it's very interesting. And it's very simple. So today, let's start with capital allocation. Where's my mouse? Now, what is the basic idea, guys, of portfolio? Why do we like to create portfolios? Why do we create portfolios? Any ideas?
Want to diversify your investment.
Exactly. So the word that we always use is diversification. Okay, so guys, if we draw this graph, okay, I will write the standard deviation in this way here. Sorry, no, I will draw here the number of, I will say number of financial instruments, okay? So it can be the number of names. It can be Apple, Tesla, whatever. And here, what I will write here is my volatility. If you have a single instrument, guys, the volatility can be very big. If you put a portfolio of 2, the volatility is going to decrease. And if you start building up more financial instruments in your portfolio, basically, guys, what will happen is something that goes like that. Got it? So by increasing the number of financial instruments in your portfolio, what happens is that the risk decreases. Okay, but there is a limit on diversification. So after these, guys, this can be a line. Okay, this doesn't continue going down. So how do we call this part of the risk that can be diversified? Of course, it's called diversifiable risk, also called intrinsic risk. It's the same name. So is that risk, is that portion of the risk that you can eliminate by simply putting uncorrelated instruments. Okay, so the main condition here, guys, not perfectly correlated instruments. We are going to understand this in the future. Not perfect, positively correlated instruments. Okay, so how do we call this part of the risk that we can basically not eliminate? It's basically what is known as market risk. Okay, so this portion of the market risk, guys, is the part that is you cannot eliminate. Got it? Of course, you can do some hedging instruments. You can use some derivatives in order to try to eliminate this market risk. But then you face another risks that we're going to deal with them later. Make sense?
Yeah.
Okay, so now let's go to capital allocation. So perhaps this is not capital allocation per se. This is the idea. This is Y portfolio. So now we can start capital allocation. Let's understand what we are doing in capital allocation. Okay, so imagine, guys, that I have only two instruments. I have a risk-free instrument that I will call, that is going to return me risk-free. And I have a risky portfolio that I will call portfolio P. Got it? Let's do an example. So assume that I have, guys, that I have $100. And then from this $100, I will invest 40 at a risk-free, and I will invest 60 at the risky portfolio. I don't want to mix risk-free. Yeah, I will say P better, okay? Just to be consistent with at P. Now, guys, assume that this risky portfolio has, let's say, 40 in equity. And let's assume that it has 20 in fixed income. Okay, so first thing to realize, guys, is the following. What percentage of my wealth, of my initial money, is invested in risk-free? It's going to be 40%, correct? And 60% in the risky portfolio. Now, when you talk about the internal composition of the portfolio, you have two ways of computing this one here. In terms of the portfolio, in terms of the complete portfolio, so I'm investing in equity 40%, and I'm investing in fixed income 20%. And in terms of the risky portfolio, so I'm investing, where's my calculator? So I'm investing 40 divided by 60. Uh, 66.67% is 33.33%. So this number here, guys, comes from 40 divided by 60, and this number is 20 divided by 60. Right? So these are the two things that we need to understand clearly. Now, the basic thing that you need to remember here, guys, is that when we talk about capital allocation, we ignore this part. So capital allocation, guys, ignores this part here. So basically assumes, capital allocation assumes that the risky portfolio composition stays constant. Okay, so capital allocation, guys, doesn't care about what is inside. What we are going to assume is that this is constant. So this implies that how can I reduce my risk? So given this example, how can I reduce my risk? Guys, what is how do you reduce the risk in this portfolio, 40/60?
Move more to the risk-free.
Exactly. So that's what is capital allocation. So if you want to reduce risk, what you do is you simply reduce your exposure to the risky portfolio, and move it into the risk-free. So for example, what you can do is, okay, I will say, you know what, I will move this to 70, and this is going to be equal to 30. Got it? So the only thing that you do is move from risky portfolio to risk-free portfolio. That's all what you do. And so what happens is the following. If you take a look, if you want to see inside this 30, what do you have in equity and what do you have in fixed income? How many dollars you're going to have from this 30 in equity? Remember, assuming that the risky portfolio stays constant implies that these percentages remain constant. Do you agree? So this implies that from these 30, 67, so basically 20 are going to go into equity just to get the 66.67, and 10 are going to go into the fixed income. Make sense? In such a way that what changes is the following. So this now is going to be 70%. This now is 30%. In terms of the complete portfolio, what we have here is 20%. Is 20 divided by 100 and 10%. However, the risky portfolio is going to be exactly the same as before. Basically, this is 20 divided by 30. And this one here is 10 divided by 30. Make sense? Make sense to you guys?
Yeah.
Okay, so the first part of the class, I mean, this class and next class, we're going to forget about this part of the equity side. We know that the composition of this portfolio is exactly the same as this one here. The only thing that changes in order to rebalance our risk profile is simply going to be changed from risky portfolio and risk-free portfolio and the risky portfolio. That's all what we're going to be doing. So remember, let's write here, this is a risk-free, and this is the risky portfolio. Questions? No questions? Okay, let's do some very simple mathematics, guys. Let's assume the following. Okay, let's do the model. Let's assume that Y is percentage invested in risky portfolio. Okay. Let's assume, of course, that P is my risky portfolio. Let's assume that F is my risk-free portfolio. Let's assume that C represents my complete portfolio, basically the mixture of risky and risk-free. And let's assume, guys, that RF is the risk-free interest rate. Let's assume that, let's assume small r. RP is a risky portfolio return. Let's assume sigma p is a risky portfolio volatility. Okay. With these definitions, guys, we're more than ready to create a very simple and a small and create a small example. Okay, are you with me?
Yeah.
So now, why the model is called the risk variance, or sorry, the mean variance model? Because we need to, in order to understand the model, I need to compute the mean and the variance. Okay, and this is going to be recurrent, guys. We're going to be always doing this one here. Now, the mean, what I want is I want to compute the expected return. So this is my mean. Expected is because it's a probability, it's probabilistic. My expected return of my complete portfolio is going to be equal to what? Okay, I have a portion y in my expected return of my risky portfolio plus 1 minus y, the risk-free. Now, why the risk-free is not expected? Because it's a constant. So the expected value of a constant is a constant. Make sense? So what is expected value, guys? Is basically the average, kind of the unconditional mean. Okay, so what I will do is I will rewrite this one for a little. The expected return of my complete portfolio is going to be equal to YERP plus RF minus YRF. So these two are common. So basically my main equation, guys, is going to be RF plus common factor is Y, ERP minus the risk-free. How do we call this one here? This is what is called, guys, the risk premium. And this is going to be my equation number 1. Okay, so what I've done is I have found what is the mean of my model. So what is next, guys, is I need to compute the variance. The variance between what and what? Well, the variance of I, the proportion that goes into the risky portfolio, and the proportion that goes into the risk-free portfolio. So guys, the formula is simply when you have, in general, when you have variance of A comma B, is simply going to be the variance of A plus the variance of B plus 2 times the covariance of A comma B. Okay, so this is going to be, guys, your general formula, please. So this is a general formula. Oopsie. Yeah. Okay, So let's solve the formula. So it's going to be, this is going to be the variance of YRP plus the variance of 1 minus Y RF plus 2 times, as soon as I have weights, it's going to be Y, 1 minus Y, covariance of RP, RF. And then here we have a couple of things to discuss, guys. What is the variance of a constant? Equals what?
0.
0, exactly. Okay, so this implies that as soon as this is a constant, this part here, oh, what I done? This part here, what? This part here disappears. Agree with me? Guys, you agree? Because the variance of a constant is simply 0, so it disappears.
Because here we're looking at the variance of risk-free.
RF of the risk-free, exactly.
Yeah.
Exactly, and the risk-free is a number. 1%, 2%, 3%. It is assumed never to change. Now, this is the first rule, the second rule, and there is another rule. What is the covariance of a constant and a variable? Also, guys, I will explain you, will give you the details later, is also equal to 0. So this implies also, guys, that this part here, so all this part here disappears. Okay, so we end up having the following. I will call this variance of all this part here, okay, is going to be, this one here is going to be sigma square complete. So sigma square complete, that is the variance of this part here, is simply equal to, oh, there is another property. Give me 1 second. There is another property, guys. And with this, I think that's all the properties we need to know. The variance of a constant K times X, so this is a constant, and this is a variable, is going to be simply equal to K square. So this, the constant gets out square, variance of X. So this is the other rule. Got it? So if I use those rules in this equation here, this is equal to variance of YRP. This is equal to Y squared, because Y is a constant, Y squared variance of the risky portfolio. And this guy is going to be called sigma square of P. Simply, sigma square C is going to be equal to Y squared sigma square P. So this is the variance. From here, I can compute the volatility. The volatility of the complete portfolio, guys, is going to be equal to Y sigma P. So this is my equation number 2. So basically, the variance of my complete portfolio is going to be a function of the variance of my portfolio. If this number is 0, the variance of my, imagine if I invest 0 in the risk, okay, copy first. I need to be sure that you are following me here.
Professor, and here P is a risky portfolio share, right?
The P?
Yes.
Yes, is a risky portfolio. Okay, guys. Make sense to you? Okay, so let's do some simulations here. Let's do one example. Okay, let's assume that the expected return of the risky portfolio equals 15%. Let's assume that the standard deviation of the risky portfolio equals 22%. Let's assume that the risk-free portfolio equals 7%. Okay? Make sense to you? Now, my question is the following. One, if y equals 0, what is the expected return of my complete portfolio? What is the variance of my complete portfolio or the volatility of my complete portfolio? Okay, we are going to find how to find y, but at this point, assume, I give you, you know what, y equals 0. What is the meaning of y equals 0, guys? What is that?
We did not invest in risky portfolio.
Exactly.
At
We
all.
put everything, exactly. We put everything in the risk-free portfolio, correct? So if I use this equation here, okay, let's assume equation number 1, this one here. If y is 0, what is the expected return?
Risk-free interest rate.
Exactly, the risk-free interest rate. Now, what is the variance of my complete portfolio if y is 0? You use equation number 2. If y equals 0, what do we get here?
0.
0. Okay, now you understand how to do that. Now assume that y equals, imagine 0.5. So you tell me what is the expected return and what is the variance of the complete portfolio. Can you compute that? And finally, one example, what happens if y equals 1? What is my expected return of the complete portfolio and what is the variance of the volatility of my complete portfolio? Can you compute these two numbers, please? You help me, guys. If it's 0.5, I use this one here. If it's 0.5, it should be 7 plus 0.5 that multiplies 15 minus 7, correct? Guys?
Yes. I
So
just
this
have
is
to calculate.
Where did
8.
you get the 7 from? Oh,
What-
the R. Okay.
I'm using this one, equation 1. Okay. So 15 is 8 times 0.5 is 4. So this is 11.
Sorry, we're not converting 15 and 7 decimal to decimal.
No. Normally we use these numbers. So guys, yeah, let's use these numbers without the percent. We don't use fractions. We use the numbers. Okay. So this number, of course, is going to be 11%. Just gives us direct answers. I get 11%. Do you get 11%? Do you got 11? Did you get 11%?
Yes.
Okay, perfect. And this one here is going to be 0.5 that multiplies the standard deviation of P. So it's also 11%. Well, this is pure casualty that they are equal. Now, what happens if Y equals 1? So if Y equals 1, I have, this is 1, this negative goes with this one here, and then at the end of the day, I end up only having the risk-free, sorry, the risky portfolio. So this is 15%. Everyone understands that?
Yes.
Yes? If Y is 1, guys, so this negative RF with this positive RF cancel out, and then what is left is simply ERP. And what is the risk, the volatility of the complete portfolio is going to be 1 times 22%. This is going to be equal to 22%. Okay? So from here, and then I stop here. From here, guys, I can do the following graph. This is going to be sigma. This is going to be the expected return. And when sigma is 0, what is the expected return? The risk-free. Agree with me, guys? Do you see that?
Yes.
Then when this is going to be 11%, so this is equal to 7%. Now, when I have an expected return of 11, my volatility is going to be also 11. So I have a point like this one. Then when my expected return is 15%, so somewhere around here, my volatility is going to be equal to 22%. Somewhere here. Agree? And then, guys, if you join all these points, it must be a line, okay? It doesn't look like a line, but it's a line. This line here is called the capital allocation line. And we're going to discuss more about that in our next class. Make sense? So,
Professor,
yes.
So on the vertical axis, we have expected return
returns.
for the whole portfolio,
For the whole,
right?
yes, is the complete portfolio. Yeah, perhaps I don't do the, I write complete just to be sure that you understand. So this is the expected return of my complete portfolio. Sorry, RC, complete portfolio. And this is sigma C, my complete portfolio. Got it? Make sense, guys?
Yes.
Perfect. So we stop here. We're going to do a lot of examples here. Don't worry, you're going to get it. Okay, we have time, so we're going to invest a lot of time on just doing examples and examples, and you're really going to master this part of the class. Okay, guys, so we see you next week. The first 10-15 minutes are going to be for questions related to the topics of the exam, and then we continue working with this, and on the 11th, we have the midterm. Got it? Okay, guys, questions? So otherwise we can stop here. No questions? You're okay, guys? Guys?
Yes.
Yes.
Okay, guys. So see you in a week then. Take care.
Bye.
Thank you.
See you
Bye.
later. Bye-bye. Take care.